Welcome to our deep dive on the mid-career retirement paradox, the tension between protecting your savings and outpacing inflation. In this video, we'll explore how investors near traditional retirement age can structure portfolios they can actually stick with, while safeguarding purchasing power for the next 15 to 20 years and beyond. Let's get started. Here's the roadmap. First, we'll explain why this paradox matters and the role of cash flow certainty. Then, we'll weigh growth versus safety through the lens of inflation. Next, we'll contrast behavioral risk with mathematical risk. We'll move on to a practical 3-bucket plan, walk through example allocations, and finish with 2 quick quizzes to test your understanding. Let's transition into a brief disclaimer before we proceed. This video is for educational purposes only. It does not constitute financial, tax, or legal advice. Market returns are uncertain, and past performance is not indicative of future results. Before making any decisions, consider speaking with a qualified fiduciary advisor who understands your personal situation. With that covered, let's move into the context of the paradox. For many investors aged 55 and older with substantial savings, the dilemma is this. You want safety, but you may not actually need to touch much of your principal for 15 to 20 years. That long horizon argues for growth assets. Yet the urge to de-risk is strong. The challenge is that inflation gradually erodes the purchasing power of cash-heavy portfolios, especially over decades. With that framing, let's visualize the trade-offs. This flowchart sets up the decision space. With a 15 to 20-year horizon, you can choose among an all-cash posture, a balanced mix such as 60% equities and 40% fixed income, or a high-equity posture like 80/20. All-cash minimizes volatility, but suffers from inflation drag. Balanced provides moderate growth and manages drawdowns better than a stock-heavy mix. High equity raises growth potential, but brings deeper drawdowns. Across all approaches, low-cost index funds spanning U.S. and international equities, plus high-quality bonds, remain the building blocks. Now, let's broaden the view with a conceptual mind map. This mind map positions 4 pillars: cash flow certainty, inflation and longevity risk, behavioral risk, and allocation options. Under cash flow certainty, you'll see near-term expenses, health costs, and liquidity. Under inflation and longevity, note how purchasing power and multi-decade horizons demand a real return. Behavioral risk highlights panic selling and loss aversion, underscoring the value of a set-and-forget approach. Lastly, allocation options include all cash, balanced 60/40, higher equity 80/20, annuities, and delayed Social Security. The goal is to pick a mix that you can maintain through downturns. Next, let's translate this into a step-by-step plan. Here's a practical structure. Bucket 1 holds 1 to 3 years of essential expenses in highly liquid, low-volatility instruments, such as high-yield savings, treasury bills, or money market funds. Bucket 2 targets intermediate needs with high-quality bonds, broad bond index funds, and potentially annuities for guaranteed income. Bucket 3 is your long-horizon growth engine composed of diversified equity index funds across U.S. and international markets. Automate your refills by sweeping interest, dividends, and occasional trims from buckets 2 and 3 into bucket 1. Finally, set guardrails, rebalance bands, and withdrawal rules before volatility arrives. Now that we have the framework, let's map expenses to cash flow needs. This table illustrates how to quantify your cash flow needs. Tally essential, healthcare, and discretionary spending for a total annual figure. Then subtract guaranteed income, such as delayed Social Security, and any annuity income to identify the net gap that must be funded from your portfolio. That gap is what bucket 1 must reliably cover for the next 1 to 3 years, while buckets 2 and 3 are designed to support and refill it over time. With this baseline, let's compare allocation paths. Here, we contrast 3 archetypes. An all-cash stance minimizes volatility, but faces substantial inflation erosion and reinvestment risk. A 60/40 balanced mix offers meaningful growth with moderated drawdowns and can be more behaviorally sustainable for cautious investors. An 80/20 equity-heavy mix pushes growth potential higher, but comes with deeper and more frequent drawdowns that can trigger panic selling. The best choice is the one you can maintain in a severe market sell-off. Next, let's capture a few rules of thumb in Markdown for quick reference. Here are 5 quick rules of thumb. First, prioritize liquidity by holding 1 to 3 years of essential expenses in ultra-safe assets. Second, take inflation seriously. Over 20 years, even modest inflation can dramatically reduce purchasing power, so target real returns. Third, remember behavior outweighs math. Choose a portfolio you can hold through downturns. Fourth, automate refills from dividends, interest, and pre-planned trims rather than improvising. Fifth, diversify simply using broad, low-cost index funds spanning U.S. and international equities and high-quality bonds. With these in mind, let's look at an example allocation visual. This pie chart illustrates a sample balanced allocation. One approach is roughly 60% equities split between U.S. and international markets, 35% investment-grade bonds, and a small cash sleeve for near-term needs. The bond allocation helps dampen volatility, while the cash sleeve provides liquidity. Reassess annually and rebalance within preset bands to keep risk aligned with your plan. Next, let's examine the behavioral journey during a market drop. This sequence captures typical behavior in a downturn. During bull markets, investors feel confident and may add risk. A sudden drop triggers fear and an urge to sell. Your written plan, including rebalance bands and predefined cash refill rules, serves as the stabilizer. By following the plan, holding through volatility, rebalancing within bands, and maintaining cash refills, you improve the odds of participating in the subsequent recovery. With that mindset, it's time for a quick knowledge check. Quiz time. Which risk most often causes permanent damage to a retirement plan for cautious investors? Option A, short-term market volatility. Option B, behavioral panic selling during drawdowns. Option C, temporary underperformance versus a benchmark. Option D, not picking the perfect fund. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is behavioral panic selling during drawdowns. While volatility itself is temporary, selling during a downturn often locks in losses and makes recovery much harder. Behavioral discipline and pre-commitment to a rules-based strategy help mitigate this risk. Let's try one more. Second quiz. What should be prioritized before increasing equity exposure for long-term growth? Option A, maximizing dividend yield. Option B, ensuring 1 to 3 years of cash flow certainty in liquid assets. Option C, timing the market bottom. Option D, picking sector-specific winners. You may pause the video now to think about the answer. We will discuss the answer in the next section of the video. The correct answer is ensuring 1 to 3 years of cash flow certainty in liquid assets. With a reliable cash buffer, you are less likely to sell growth assets at the wrong time and more likely to maintain your long-term allocation. Now, let's crystallize the key takeaways. These are the key points. A long time horizon supports holding growth assets, while inflation threatens cash-heavy portfolios. Behavioral risk can outweigh a mathematically optimal solution, so choose a sustainable allocation. Prioritize cash flow certainty by holding 1 to 3 years of essential expenses in safe, liquid assets. A balanced allocation such as 60/40ths often suits cautious investors. Finally, automate refills and rebalancing to reduce the chance of panic decisions. Next, a brief summary and your next steps. To recap, quantify spending and secure 1 to 3 years of essential expenses in cash-like assets. Build your core using low-cost index funds across equities and bonds. Choose a risk level you can maintain through drawdowns, with a balanced 60/40ths mix as a common middle ground for cautious investors. Automate rebalancing and cash refills rather than timing the market. Revisit your plan annually and adjust when your circumstances change, not when headlines spike. Finally, let's close with a thank you and a quick ask. Thanks for watching. If this video clarified the mid-career retirement paradox, please like the video, share it with someone who's wrestling with the same questions, and subscribe for more evidence-based retirement planning content. In the comments, tell us, what allocation helps you sleep at night, and how are you planning to fight inflation over the next 20 years? See you in the next video.